to Policy and Profits. I'm E.J. Antoni, Chief Economist at the Heritage Foundation. I am joined by the one, the only trader extraordinaire, founder and head of Ascalon 6 Capital, Anthony Esposito. Anthony, how you doing today? How's your week been?
EJ, doing good. You look good. Thank you for the time today. Always appreciate getting together. Week has been interesting. We're in the midst of a massive snapback rally from the lows. Definitely a lot of, well, we started with, I think, a lot of short covering derivative unwinds. It started the night heading into March 31st. Then March 31st, we saw a massive continuation of that along with a rebalance for the national pension funds, which created multiple billions of dollars of demand for stock. So you, on a rebalance, you typically sell the winners, you buy the losers. There were a lot of losers, so there was a buy imbalance. And the week's been crazy. We've seen a lot of continued rally, continued push higher. Some of it a pushback into names real buying. The CTAs, the momentum trend model, momentum trend traders are reversing out of shorts, getting long. So, and you have retail starting to step back in. They kind of whimpered away for a little while. So it's been an interesting week. That headline risk, that tweet risk is still out there. It is fading. I am noticing that we're getting bad news and the market holds. We're getting headlines that I think are going to move the market and down and it goes up, which is just a signal that the market has kind of done it's discounted and come to terms with the risk as is, and it's ready to move higher. Now, if that risk changes, we will retrace and move lower. But as of now, short of anything outside of the cone of expectation, I think everyone's wrapped their head around the downside risk, and they're in line with, I don't want to say the taco trade. I think that's the stupidest term out there. Trump has won every battle that he's lined up to fight, and this one is included. But I would say that the desire of President Trump and the administration to finish and be done with the conflict has the market thinking that this is going to be resolved. We're heading into earnings, we're blah, blah, blah. Moving forward, momentum has shifted higher on all levels, so to the upside. So it's been, long answer for a short answer, a very interesting week. It's been a challenging week. And I think we will head into a pretty interesting Friday, and next week should be just as crazy, but we'll see. The weekend should be really big with those negotiations in the Middle East. We'll see what happens. That said, how are you doing, my friend? And how's everything at the Heritage Foundation? You've been all over the place, by the way, this week on media and X, so always appreciate hearing you. But how are you and how are you doing?
Well, it's been another crazy week, like you said. It's amazing how you can literally spend all day on X. Hey, look, you're not addicted. You're just monitoring the situation, as they like to say, because literally things are just changing, not even like day to day, Anthony, right? As you know, it's not even hour by hour. It's literally minute by minute, right? We were told there was a ceasefire, and then all of a sudden we hear Iran's under attack. And then Kuwait and UAE are under attack, and Lebanon's under attack. And I mean, it's just absolutely insane. And so, again, literally just minute by minute, this thing can change, and you got to be able to just take a break from it and try to look at some of the fundamentals, I guess. And yes, granted, you're maybe looking a little more in the rearview mirror when you're going through some of this data, but it's impossible to look through the windshield at this point because there's, I don't know, it's like there's so many bugs splattered on it, I guess, to continue with that analogy. Every new piece of data, every single minute is just another mosquito or something that gets squashed and blurs your vision. So, yeah, it's certainly been crazy. Obviously, we'll get our first inflation read for the month of March. It's gonna be ugly. We knew that going into it. It's gonna be very ugly. I know some people have it as a four handle. Might be a little high to go that far. I think you're still gonna, I think you're still looking at a three handle. Some of it has to do with people are still trying to get the weights down in terms of gasoline and diesel. But I think four is a bit much, frankly. And you'll see that, I think, also when you look at the core number for CPI. Headline obviously is going to take a huge hit because of gas and diesel, but core won't, right? So core will be core will not show the same kind of sharp increase, I
Okay.
think. And obviously, the Fed's going to be looking at that, right? They're looking at core to try to look past what they see as the volatile, very volatile categories of food and energy that they don't want to be basing monetary policy decisions on.
Yep. Yep. Which are the things that we all spend most of our money on, but that's okay. We can,
Yeah.
that's, all right. So CPI, that's interesting for me on a very functional basis tomorrow because I'll be obviously on the desk and we'll be watching that carefully. I do believe, short of, again, a massive blow up, we might see a blip lower there because of a hotter print, but I think everyone's really convinced that we've already seen the height of escalation in Iran, and B, which I'm not sure about, but that's what everyone thinks. And B, I think that everyone is pretty convinced that rates are going to come down. I'm also not convinced of that, but that's kind of where everyone's at, regardless of what this
Mm-hmm.
print is.
Mm-hmm.
You mentioned the Fed, and I want to talk to you about something which you've spoken about before quite often, and that's the capital reserves at the Fed and what they look like. Now, Bernanke, and we're going to play this, last December, was talking about April 15th and reserves at the Fed. I want to just listen to that. It's a 2-minute long hit. I want to hear that. It was in one of his pressers. And then I really do want you to explain in your way what the reserves look like and what the risk is here as we head into April 15th, which obviously is tax day.
Mm-hmm.
And just on the ample reserves point, how concerned were people around the table about some of the tensions we've seen in money markets? Thank you.
I wouldn't say concerned. So what really happened is this. Balance sheet shrinkage, sometimes called QT, went on. We had a framework in place for monitoring it, and nothing happened. The overnight reverse repo facility went down pretty much close to zero. And then beginning in September, the federal funds rate started to tick up within the range, right? And it ticked up almost all the way to interest on reserve balances. There's nothing wrong with that. What that's telling you is that we're actually in reserves, in an ample reserves regime. So, we knew this was going to come. When it finally did come, it came a little quicker than expected, but we were absolutely there to take the actions that we said we would take. So, and those actions are today. So, we announced that we're resuming reserve management purchases. That is completely separate from monetary policy. It's just we need to keep an ample supply of reserves out there. Why so big? The answer to that is, if you look ahead, you'll see that April 15th is coming up, and our framework is such that we want to have ample reserves even at times when reserves are at a low level temporarily. So that's what happens on tax day. People pay a lot of money to the government, reserves drop sharply and temporarily. So this seasonal buildup that we'll see in the next few months was going to happen anyway. It was going to happen because April 15th is April 15th. There's also a secular ongoing growth of the balance sheet. We have to keep reserves, call it constant, as it relates to the banking system or to the whole economy. And that alone calls for us to increase about $20-25 billion per month. So that's a small part. That's going on. It's also happening in the context of a temporary few-month front loading to get reserves high enough to get through the tax period in mid-April. So that's what's happening there.
So I just want to put it to you this way. Everyone focuses on the Fed funds rate, whether it's guys I'm speaking to on other desks, buy-side desks, sell-side desks, sell-side research, buy-side research, the pontificators on CNBC, on Bloomberg, on Fox Business. Everybody's talking about the Fed funds rate. You're one of the few people that does talk about other tools in the toolbox at the Fed, in addition to talking about yields across the board. And you dig in more versus that shiny ball that everyone's talking about, the overnight rate. So if we're talking about reserves, where are the reserves at the Fed? How does this come into play? And is there a risk currently with the reserve balance?
So these bank reserves that we talk about on the Fed's balance sheet, Anthony, if you want to think of it as like an upside down pyramid, and these are kind of the basis of the money supply. So they're that bottom portion of the pyramid, right? And essentially, as you let's go back to pre-COVID, right? Bank reserves were considerably smaller than they are today. And then if you go back to before the GFC, considerably smaller than afterwards. What the Fed has basically done in each of these instances is essentially create a ton of money and just buy up all of these assets, grow the balance sheet in order to cover up losses. You know, I mean, arguably they first did it with long term capital management in the 90s, right? That was the first time, not necessarily that the Fed helped conduct a bailout, but that the Fed really led a bailout. And again, same thing with the GFC, same thing with COVID. It was Powell, let's not forget, who went to Congress and said, hey guys, a couple $100 billion is not enough of a stimulus package. You need to spend trillions of dollars here. That was Powell, who was really the ringleader behind that. And he talks about these reserve management purchases, whatever euphemism he wants to use there. It's just like QT. It's all the same thing. It's the Fed buying assets, and it's buying assets with money that it's creating out of nothing, right? That is by definition expanding the money supply. So he talks about it, and he says it's not a monetary tool, right? This is not about monetary policy. This is about creating enough liquidity in the banking system. So part of that's true, part of that's absolutely incorrect. What's true is that under the framework that they have set up, that Bernanke first started with paying interest on excess reserves, and then that Powell really kicked into overdrive in March of 2020, where they now pay interest on all bank reserves, right? They have created this really novel monetary system where reserves have to stay at a certain threshold, and if they start falling below that, the financial plumbing starts to run dry, and you start to have serious problems in that financial system. So again, that means that you just have to keep this minimum level of bank reserves. And one of the problems is that if you have the central bank setting interest rates instead of the central bank just simply allowing the market to set rates, in other words, let that interest rate float, now you have the Fed trying to determine two different variables, which means it's basically guaranteed to get it wrong. And sure enough, that's exactly what the Fed has been doing, right? The last 6 years. So all right, let's try to wrap this up though, so we can get to like really what's going on here. By constantly having to add liquidity, increase those bank reserves, right? Powell is creating a kind of minimal amount of inflation. In other words, you're never going to be able to really get monetary inflation down below this certain level because Powell just has to keep adding money, adding liquidity into the system. And so this goes back to that comment you made on, everyone gets too fixated on just the interest rate, right? And they're missing what's been going on with bank reserves. You and I were talking about this over a year ago, Anthony, right? About how this is coming. Once the reverse repo facility drains, which Powell mentioned, once that's gone, they have to start adding liquidity because that facility represented, you could think of it as the excess liquidity. Now what happened? Well, now the regular repo facility had to kick in. That's where the Fed is temporarily injecting liquidity. And when the Fed then purchases, instead of just using the repo facility, now it's not a temporary injection. Now it's a permanent injection, at least permanent until those assets mature, right? And then it's just going to do it all over again. So the Fed is back on a path of permanent liquidity, adding permanent liquidity. So we're back to growing the balance sheet. We're back to an inflationary posture, you could call it, when it comes to monetary policy, regardless of what you think is happening with interest rates.
Which is insane because in a very real way, that will be supportive for equity markets, and that's a bullish indicator. Right. Whether or not it's good or not is not the question. And I've said a few times that Warsh coming in and changing the way the Fed manages its balance sheet and rates is not what's best for the market, but it is what's best for the economy, inflation, and our equilibrium of liquidity, which is way off. You think that's fair to say? Am I way off base there, or is that a good? I mean, definitely this inflation, this injection of liquidity and inflationary pressure, just enough will keep the market supported, minus any major event like Iran. But for the most part, the earnings in the S&P are from the year 2000, are about 75% of their earnings growth is inflation. It's not in real terms, they haven't grown earnings at all. It's all
Right.
inflation. So does that make sense to you that this reversion back to we're a liquidity provider, we're going to continue to shoot ourselves in the foot, but the markets are going to react positively to that?
Yeah, I think Warsh's take on monetary policy and what he plans to do in terms of shrinking the balance sheet, letting markets have much more of a say in the level of interest rates, which implies that they'll be lower. I think in a lot of ways, I think that's going to be a healthy kind of return to normalcy, if you will. Again, this idea that the Fed can just grow its balance sheet as big as it wants and it's somehow not going to impact inflation.
Yeah.
Let's not forget before Powell and Bernanke and the rest of these clowns growing or shrinking the balance sheet, it was widely understood that that was the Fed's primary tool
Yeah.
in affecting the level of inflation. And now these people today talk about it as if it doesn't, as if it has no impact at all. And again, I think this is the problem with the Fed trying to manage multiple different things that are all interconnected, right?
Yeah.
And the Fed is trying to manage them as if they're independent. So it's creating artificial downward pressure by hiking interest rates,
Yeah.
and it's creating artificial upward pressure by growing the balance sheet. And again, it's as if these people at the Fed are just scratching their head and they don't understand why SOFR is blowing out, secured overnight financing rate, why that is repeatedly blowing out, why they're having to keep adding liquidity to the system. I mean, again, it's astonishing. It's as if these folks don't realize how interconnected this all is.
Yeah. Well, let me ask you this, and then we'll go on to the market, which has been a monster. Warsh coming in and shrinking the balance sheet would imply that, not imply, it would create a reduction in liquidity as they sell those assets and pull capital, pull dollars back into the Fed. That should be reducing liquidity. Is that correct?
Right. So you're going to have to, as Warsh, you're going to have to pair these different mechanisms together. In other words, you can't just simply have the Fed sell off the balance sheet, but then not undo all of the other mechanisms that Powell and company have put in place. You really need to just undo the entire thing, and that's got to be done very, very carefully so that you don't end up in literally a financial crisis, right? I mean, that's what almost happened in what was it, March of 23, I guess it was, when Silicon Valley Bank blew up, and First Republic and a bunch of others, right? We literally had a regional banking crisis because even Powell, who helped create the system, wasn't even sure how to manage it. So as the Fed is draining all this liquidity by shrinking the balance sheet, right, you have to increase the amount of money that banks are sitting on that they can lend. So instead of banks just keeping money parked at the Fed, they have to start pushing that out into the private sector. You got to kind of be taking away with the right hand and giving with the left.
So let me ask you this. What should be the end result? And what's the downside? If it doesn't work, what is the result that would be the negative result? So what are they trying to get done? What does that look like? And then if there is a mistake or it doesn't work perfectly, what kind of downside are we looking at as they remove these policies and reset Fed activity?
So I think what it looks like if they do it right, and if a few other pieces that are honestly outside of their control fall into place, it looks like a return to something similar to the 1990s, honestly,
Okay.
where people can almost predict what the Fed is going to do based simply on things like a dollar index, looking at, okay, here's how much of a basket of commodities the dollar can buy. And based on that, we know what the Fed is going to do. And these bank reserves and the Fed's balance sheet are incredibly small relative to all these other measures, whether it's different measures within the banking system specifically or the economy broadly. So that's I think what things look like, again, if all goes according to plan and if everything goes well. But again, some things are out of their control. One of which is going to be government spending.
Yeah.
Part of things going well means the Fed letting the market have a much bigger say in where interest rates are, as opposed to trying to force rates up and down. The problem is that if the government is not going to get its spending under control, those rates are going to keep going higher in a pretty dramatic way,
Well, if you're
right?
talking about the 90s and you're talking about, I mean, I don't want to interrupt you, but this is like a great point. If we're looking at the 90s, correct me if I'm wrong, then we're looking at higher qualification standards for loans. We're looking
Mm-hmm.
at higher interest rates, and we're looking at much less liquidity, right?
Compared to today, absolutely. But also, government not running massive deficits. In fact, at some points, running surpluses. So basically, what that means, Anthony, is you're
Okay.
going to take this huge pressure on the loanable funds market and remove that. And so this is why what basically part of the system that they've built today has transferred liquidity out of the private sector and put it into the public sector. So while it has pushed up interest rates on things like mortgages, credit cards, auto loans, student loans, you name it, all those interest rates are artificially high today in order to keep the interest on treasuries artificially low. So to keep those treasury yields down, we've done it by siphoning liquidity out of the private sector where all those interest rates have been forced up. So again, this is why I say some of this is I think outside of the Fed's control, to be fair to them, right? They're trying to accommodate runaway fiscal policy.
I have to tell you the truth, and we haven't discussed this until right now on the show, but I would be extremely bearish on them putting the toothpaste back in the tube. Like this is a massive issue. To try and get all of those circles put together in one line is going to be I would say it honestly it's near impossible, if not impossible. And I think that, and I'm just from what you're saying, I don't see all of that lining up. We can start with government spending, but I just don't see all of that lining up. And if it does, it's going to be a very difficult. Honestly, it's going to be a very difficult half a century to a century to get. Am I wrong in saying that? It just seems like what they need to do to get this all back in order and pull things back to the baseline is basically impossible. Am I just being very bearish on that, or?
So I was much more optimistic 2 months ago. Honestly,
Okay.
I think $100 oil is going to be a big shock that is really going to hurt. I think the extra $200 billion that we're going to have to borrow, right? It's not just spend, it's borrow for the war. I think that's really, really going to hurt. Treasury yields have not moved in the right direction
No.
since that announcement was made. So, again, you're looking at government spending going up at the same time. GDP growth is going to shrink. Not to say GDP is going to shrink, but the growth of GDP, all of those forecasts have come down in a pretty significant way.
Yeah.
When oil prices doubled. So I'm much less optimistic about what Warsh is going to be able to get done in 2026 versus next year. Because again, the calculus really has changed, I think, pretty dramatically in the last couple of months.
I'm with you. This is definitely this will be concerning. And another headwind. We talk a lot about, and we're going to go to the market now. That was awesome, EJ. Honestly, you always educate me, but that's a breakdown that I haven't heard before, and a thought process. I really need to sit on that. I'm going to be calling you later tonight or tomorrow to have you explain it to me. Maybe pull up. We'll do a Zoom call. You get a whiteboard up and try and teach me. The markets are kind of working through all of this right now. And I said this last week and the week before. We can pull up that weekly chart that we've been looking at now for months. Let's start here. So the S&P 500, I'm listening to everybody on TV talk about what just happened. And the same guys that 2 weeks ago had crocodile tears and really didn't know what to say and are now like standing there very chest puffed out saying, well, I told you so, and I knew it'd be okay, and you got to buy the dips, and when blood is on the street, and all the cliches. So not to sound like that, but I'm going to sound like that. This is what we've talked about from mid-February. It had nothing to do with hindsight. It had nothing to do with looking back. I want to be really clear. And I want to go back and remind everyone and go through what we talked about before it happened, not after. Before it happened, I suggested in mid-February two things. One, the market structure was very similar to me as it was in December, fourth quarter of 2024, heading into 2025. At that time, you can go back on my X posts at that time, real time, November, December, January, I was calling for a major move down in the S&P of 10 to 20%, which we got. Why was the structure the same? Well, the structure in very general terms was the same, and we look at a lot more here as far as our model. But in basic terms, we saw weekly momentum start to shift down as the market was at all-time highs, and in the case of 24, double topping at all-time highs, leading me to believe that market structure and underlying strength was breaking down. This is the weekly chart. We saw it on the daily. We saw it on the monthly. There was clearly a change in structure of the market. We got that move down. Okay. What did we see in this past January, November, December, January? We saw the same type of action. We saw the market at all-time highs, and what I determined was a reversal pattern on the weekly chart. We have a ascending wedge, which is a bearish reversal pattern here, coupled with the breakdown in weekly momentum. I saw it on different timelines as well, but the weekly momentum breaking down as we make our way through an ascending wedge, bearish pattern. I called for a breakdown below the pattern. I called for a first target price of 6,600 and the second target price of 6,400. We hit both of those targets. We actually hit a low the week of April 3rd at 63.53, overshooting the 6,400 target and holding just above the 100-day, which was at 63.52. So everything worked exactly as we had said back in February. The trade was a phenomenal trade. On a net basis, to be very transparent, Ascalon 6 returned over 7% in March. A lot of it due to all of it due to our model trading, but this particular call and those price targets were front and center across the board on the desk. So what have we seen now? Well, we saw some trade signals lower heading into the end of the month. As I mentioned, we saw some positive divergence in price. Pessimism as far as Iran had kind of reached a fever pitch for the moment. It looked like we were moving towards some resolution. The idea that President Trump wanted to de-escalate and get done the balance of his agenda in Iran makes sense. All those things are kind of hypothetical. What's not is technically we saw positive divergence below. We knew there was a big pension rebalance for the end of the month in March. That was going to create a lot of demand last day. And then we had this uptick in news and we started to lift. Technically, we're actually, let me look at the board. Today we were in the 6th day of our positive signal for the S&P, the 7th day of our positive signal for the Russell. So we saw on a model basis here a shift over a week ago to positive, even near the lows just coming off, and we've continued to carry through. We're 7 straight days of gains on the S&P. We're within 2.5% of the all-time high. And what you'll see on this chart as we finish is we've now moved through all moving averages. We just got through the 10-day today, or this week, and we're heading up to the base of that ascending wedge now. That base should be, it's going to mark up right around 6,900 on the front month futures. Front month futures went out today at 68.63, so we're about 40 to 50 handles away. The target's a little higher, but it's close enough for government work. 6,900 is our upside target. That is the base of that ascending wedge. If we were to break into that, then we would be moving to the top of that wedge, which is well above 7,000. That's going to be around 7,100. So what I'm saying is there is real upside momentum now. There's been a real shift in sentiment, obviously, and in momentum. I'm looking for a test of the base of that ascending wedge to the upside and potentially looking for a move if nothing else happens or there's no major derailment in the Middle East. I think we get a move through 7,000 potentially to all-time highs. And I love to hate them. I am a bear at heart, but I like green P&Ls and reporting good net performance each month to the investors. So We are leaning long here, and we're trading this market long. What I would say is the shiny ball of Iran, as that starts to settle, is going to now bring up the things that you're talking about, EJ. It's going to start to bring up private credit, which was a major question before this all blew up. It's going to start to bring up the Fed rates, the balance sheet, liquidity. We're heading into earnings season. That's going to be a key. The financials have been dismantled. We're going to start earnings season with the financials next week. We're going to see what those numbers look like. And not only what they look like, because quite honestly, it doesn't matter. What matters is how the market reacts to them. So we're looking at market reaction to all of that anecdotal news and fundamental news on a technical basis here. We are leaning long here. Our model's positioned long on all timelines. Well, long to neutral on all timelines, but on trading timelines, we're positioned long, positive, and we're going to stay that way. Very conscious of the headline and tweet risk, very conscious of that known unknown and unknown unknown, but to step in front of this now doesn't make sense unless something changes. And to mark up targets, again, the bottom of that ascending wedge, which worked out really, really well for the trade. As boring as basic as it may seem, it was pretty accurate. I haven't seen anything out there that was as accurate, almost, to the point. 69 and a quarter is the next upside target. And then from there, we're obviously looking at 7,000 as a big round number and 7,100. That's where we stand now. I love this weekly chart. It's served us really well. I think it's been a great conversation on the podcast. We're going to continue to focus on this and work through kind of like chapter by chapter. So every show we'll go into the next week. We'll see how this develops, and I am quite sure we have some room to the upside. I'm also quite sure that we are going to start to break down as we move forward, because there are underlying headwinds that I don't think anyone has. I think the discount will give us a little more push to the upside. As those headwinds start to come to light, I think we'll start to reverse back down and retrace some of this run. But we'll see if that happens, and when it happens, we'll be on top of it.
Anthony, it just never ceases to amaze me. I know I've said this before, but bears repeating, especially in these insanely volatile weeks that we've just been through, right? The retail investor who's just trying to do things, on feel or whatever, crazy system each individual person comes up with, that's not really like grounded in fact and empirical analysis like this is. Retail investors have just gotten slaughtered for the last month. I mean, absolutely annihilated. And then you look at a system like this where even if it might struggle, maybe that's not the right word, but it doesn't necessarily perform optimally, get the best returns in these periods of real high churn.
Yep.
You still end up, you still end up doing well, right? You're not going to lose it all. Like again, so many of these retail investors have over the last 5-6 weeks.
Yeah, it's been a really tough market, and I think it's funny. You look at I try and keep things very simple here, and we say I speak to investors, and I'm like, the process is it's simple, and it's really not. It's not overly complicated, right? We want to keep it as simple as possible. Our model is very efficient. I'll say it's not simple, it's not easy, it's efficient. I want the best return, the best risk-adjusted return with the least amount of inputs. I don't want to look at 1,000 different things. I don't want to trade 1,000 different things. We trade 5 asset classes here. That's it. All in the future space. We want to be efficient. We want to be effective, and we want to be able to manage through, moments and periods of high volatility as well as low volatility, as well as up moves and down moves, and be able to make money in both. And I think that's where the efficiency and the simplicity of the model comes in. If you're kind of throwing stuff at the wall to see if it sticks, it'll work as long as everything's going up. And when everything stops going up, or when you buy the dip down 3% and you go down 10%, and you're kind of catching knives the whole way down, you can give back 2 years of gains in a week. And I'm sure people have, unfortunately. So I appreciate it. EJ, you're always very supportive. I know we talk a lot about the strategy and the portfolio. I've spoken to you at 8 o'clock at night, trading futures about it. I've spoken to you at 1 o'clock in the morning, trading futures about it. So appreciate the time. I appreciate your insights as well on the policy side. Really, the Fed is going to be key here for a lot of reasons. maybe more so in the coming 6 to 12 months than almost ever before that I can remember. This is for me, this is a huge Fed period. It's almost like a make or break moment, and everybody's watching as they always are. So thank you, sir. Appreciate the time. Always a pleasure. And I will see you next time.
Till then, Anthony.